Right here is the hourly chart of the Nasdaq 100 March contract. Last week, I decided to take the entire week off, and as you can see, this contract is no longer being traded, so let's move on to the June contract. The reason I took last week off is simple. I chose to not work. Trading is work to me. I got into this profession for freedom, and trading is one of the rare fields where doing less is sometimes the smartest decision. I'm at the point in my career now where I genuinely look forward to taking time away from the charts. You'll see a lot of traders online saying they hate weekends and can't wait for the market to open on Monday. To me, that's a sign of vulnerability, someone who can easily be trapped by the market. Not in the sense of liquidity traps or chart patterns, I'm talking about the psychological traps of fear and greed. Once you reach the point where your mindset is, the market is open, time to work, you're already ahead of most traders. Because now trading is no longer entertainment, it's no longer emotional stimulation, it's work. And the moment it becomes work, you stop approaching the market like something to chase for excitement. I actually have a checklist for when to take days off. That includes high-impact news events like FOMC, CPI, and non-farm payroll, as well as bank holidays, contract rollover, and holiday seasons. Last week we had contract rollover on Tuesday and FOMC on Wednesday, while price was also trading in a higher time frame consolidation. On top of that, I was behind on my content, so when I look at the full picture, taking the entire week off was the right decision. A lot of people treat not trading like it's a weakness. I see it as discipline. I did spend a lot of time on social media last week, and I have to say I came away very disappointed by what I saw, because what attracts most traders is rarely what would actually help them. They are more willing to buy into confidence, branding, and perceived skill than real evidence. But that's a conversation for another video. Let's get into the technicals. Here's the weekly chart. A few weeks ago, I mentioned that price had been spending a lot of time in premium of this range, and to me, it looked like heavy selling was taking place. I had been targeting these lows since the start of this series. Price has now finally closed below them on a weekly basis, but it did not happen in a straightforward manner. There was a lot of stalling, back and forth, and manipulation in between. You'll see what I mean once I move down to the daily chart. Right here is the daily bearish order block. If you go back to my March 9 commentary, where I reviewed the trades taken during the period highlighted on this chart, you'll see that I attempted multiple shorts based on the context of this order block. Yes, my lower time frame executions are built around higher time frame levels. That's a gem for you, free of charge. For this order block to be invalidated, price would need to close above its mean threshold. The market never violated this bearish PD array. At the same time, it also was not doing what it was supposed to do, which was deliver price lower. So going into the following week, I had no real bias. The cost of trading while my view on price was unclear was minus 6.5 R, which still left me up 0.5 R overall. The higher time frame weekly chart is still pointing bearish. Geopolitical tensions also supports that view. Price had already closed below an intermediate term swing low on the weekly chart. By all accounts, this market should be trading lower, but given how this asset has behaved all year so far, I'm not going to hold too tightly to that bias if next week's price action continues to show reluctant to move lower. If this market remains bearish, this weekly volume imbalance is my downside target. But until price show more commitment to the downside, I'm not going to overcommit to that idea. That's my view for next week. Let's see how the market develops.